Hello, today's topic is leasing. We will solve two questions. The first one is lease of a machinery. The second one is lease, sale and leaseback. In the first scenario, on January 1st, 2011, the company Wilshire leased a machinery under 5 years lease. The useful life of this asset was 4 years and there is no residual value. Annual lease payments are 6 million payable each year. At the end of year, the company will pay is for 5 years, and its net present value of the future cash out is already given in the scenario. It was 24 million, but we don't need this figure because the implicit interest rate was already given with 8% in the scenario per year. And also the company incurred 0.4 million of direct costs when arranging the leasing. Okay. As you know, asset in leasing arrangement will recognize as right of use asset, and which is net present value of future leasing payment. There are 5 years needs to be paid by company with 6 million, year 1, year 2, year 3, year 4, and year 5. The interest rate was already given, which is 8%. And each year payment, the holder of the machinery was 6 million. Let's calculate the net present value here. This is the formula in Excel: net present value, rate, and data range. And this is roughly 24 million, but we are going to use 23.6 million here. Okay. In the initial recognition, which is January 1st, $2011 20x1 debit right of use assets. It would be net present value of future leasing payments, and credit the same amount with liability. Also, there is a cost incurred by company when arranging the leasing. The amount was 0.4 million, and this amount should be recognized as an asset rather than going to P&L. This is important. Debit, which is subject to depreciation. We assume that it has been paid by cash. Okay. Then go to end of the year. December 2011. Let's first calculate the depreciation. Useful life of the assets was here 4 years. And P&L. This is total carrying value of the asset before depreciation end of the year, divided by 4, because the useful life of assets was 4 years. Each year, this amount should be recognized as a depreciation expenses. Credit should be deducted from right of use asset, and allowance account might be used here. Again, end of the year, there would be a payment of leasing. Also, these liabilities is net present value of future cash out at the beginning of the leasing arrangements. We need to find net present value of these liabilities end of the year first. How to do that? Credits, is liabilities. We need to unwind using interest rate divided by interest rate, and before payment, year-end these liabilities balance would be 25.almost 9 million. This is finance cost. We'll go to P&L, and also there would be a leasing payment of 6 million cash would be deducted from liabilities, of course. In order to calculate future balance of leasing liabilities, we might together prepare a table here. Year 1, year 2, 3, 4, 5, because it was 5 years arrangements. Opening balance was net present value. This is finance cost, 8%, and payments from liabilities and closing balance. Okay. This is summary of leasing liabilities. And finance cost, opening balance multiply by interest rate. And payment should be deducted from leasing liabilities. And this is open balance. We need to reach end of the term 0. Again, open balance. Let's move myself to another slide of the Excel file. Here. End of the year 5, we need to reach 0. Yes. Each year, opening balance, finance cost, payment, closing balance. Opening balance, finance cost need to be added and deducted. The payment should be deducted, then closing balance, and end of the year 5, of course, the leasing liability balance should be 0. Okay, let's jump to another question. Leaseback. This is a complicated than the previous one. In this scenario, the company Apple needs a fund, and to finance itself, the company has a building already in use. The company is selling its maybe head office building, yes, and at the same time, the company is leasing back in order to use it for its operation. The arrangement is for 10 years. Each year payment is 1 million. Current value of the building is 10 million. Carrying value in accounting record was 8.4 million. Interest rate for this leasing, this arrangement was 5%. How to record these arrangements? This is sale amount, 1 million here. Fair value, it is also the same as sale amount. Under normal circumstances, in this type of arrangement, fair value should be equal to or very close to sales value. If there are significant difference between them, it would affect the accounting treatment of costs. But there's another scenario. And carrying value, 8.4 million. Yeah. And let's calculate net present value here. Year 1, year 2. Each year, 1 million needs to be paid. Yes, net present value at 5%. Yes, 7.7. Let's round it. Okay, 7.7 million. This is net present value of these arrangements. In this type of question, net present value cannot be treated as right of use asset because we are selling first and leasing back. We need to find the right of use asset portion of net present value. Asset portion. Which is carrying value divided by fair value, 18%, and right of use asset, that would be net present value multiplied by right of use asset portion, or carrying value divided by fair value. This is right of use asset subject to depreciation, and this is the asset on our balance sheet. And right retained company. Net present value minus right of use asset, and also gain fair value minus carrying value, 1.6 million, but gain on right transfer to buyer will be gain minus right retained at company. Okay, after this calculation, let's prepare accounting treatment in the initial recognition. That it should be right of use assets 2.5 million. Company collected 10 million. Also, building would transfer cost, building transfer to third party, and with the arrangement of leasing, right of use asset would be new asset on balance sheet rather than building. Which is carrying value of 3.4 million. And also liabilities, the easiest part. Which is net present value. Again, each year we need to calculate finance cost at the rate of 5%, and also, and we need to add this amount on leasing liabilities. And each year also 1 million of leasing payment should be deducted from liabilities. At end of year 10, this liabilities balance should be 0. And credit, again, P&L or gain, which is gain on right transfer to buyer. Total amount is 15.5 million almost, and right, so the plus cash is 16.5 million. Okay, thank you, friends. Hope see you in other questions.